students, hope you are doing well. Today in this video, we are going to discuss accounting ratios, part 2nd, and in this ratio, we are going to discuss the solvency ratio, that is also called long-term solvency. These ratios are based on balance sheet, and in this particular ratio, we are trying to ascertain the solvency of the company. That means, is company is able to pay its debt? Okay. Now, what is solvency means here? Refers to the ability of the enterprise to meet the long-term indebtedness. Long-term liabilities having maturity of more than 1 year are treated here the long-term indebtedness. Thus, the solvency ratio helps to determining the ability of the enterprise to meet its long-term obligations. It includes different types of ratios, that is debt to equity ratio, total asset to debt ratio, proprietary ratio, interest coverage ratio. So first of all, we are going to discuss here the debt equity ratio. The debt equity ratio is the relationship between long-term debts and shareholders' fund. It means the long-term debt and equity ratio compute to find out the long-term financial soundness of the enterprise. The ratio indicates the relationship between long-term debts and shareholders' fund. The ratio is calculated as debt upon equity, which is written here like long-term debts upon shareholders' fund for your better understanding. So, what long-term debts include are long-term borrowing and long-term provisions like debenture, mortgage of loan, bank loan for financial institution and public deposits. Okay. Now, the second component of this ratio is shareholders fund. What is shareholder fund? As per the revised schedule, the shareholder fund include share capital, which include equity share capital and preference share capital. Okay, state in notes to account under the head of subscribed capital. And reserves and surpluses are included like capital reserve, capital redemption reserve, security premium reserves, general reserve, etc. Okay, so it include both of them, and now we get the component that is long-term debt upon shareholders fund. Okay, so for calculating debt equity ratio, we divide long-term debts to shareholders fund. The debt equity ratio tells the proportion between the long-term debts and shareholders fund. So the ideal ratio of debt to equity is, remember that, 2:1. Ideal ratio of this ratio is 2:1, right? So if the ratio, the debt equity ratio is more than 2:1, it is considered good position, and if it is lower then it will showing the use of owner fund in a wrong way. This implies the great safety of margin to creditors. Safety of margin here means the difference between the loss and the profit is called safety margin. Okay, the higher debt equity ratio means more risk to creditors or lower safety margin to creditors. The ratio indicates soundness of the long-term financial position and indicating the independence to the enterprise in outsiders fund. Okay. Now, total asset to debt ratio, as you are not worried about remembering the ratios because the name of the ratios is already suggests you the formula. Okay, so total asset to debt ratio here means the total assets are divided by long-term debts. So what are total assets? It includes all the components which are shown in the balance sheet in the asset side, like non-current assets plus non-current investment plus long-term loans and advances and current assets. Okay, so these are called total asset. Now second is debts. What it include? We have already discussed the long-term borrowing and long-term provisions, right? Now the another ratio here is proprietary ratio. The proportion of total asset funded by the owners and shareholders are called proprietary ratio. The ratio indicates relationship between proprietor's fund and net worth to the total assets. Okay, it is expressed both in the form of ratio and percentage also. So here you know that what total assets include, and also you known as what equity the shareholders fund include. Shareholder fund include what it include? It include all the share capital as well as reserves and surpluses. Okay, so this ratio indicates the proportion of total assets financed by the proprietor's fund. The higher ratio is considered good from the point of view of the financial soundness of the company, but the lower proprietor ratio implies the insecure long-term lenders of the money. Okay, so ratio below 50% is not considered good for lenders as signifies lower margin of safety for them. Okay, now the last ratio is interest coverage ratio. The interest coverage ratio here means the profit before interest and tax is divided by fixed interest charges. Okay, so interest coverage ratio indicates or establishes the relationship between EBIT and the fixed interest rate charged by long-term debts. Okay, so it is very important to ascertain that if we are able to pay interest on debt or not, because on the basis of this we are able to avail debt from the sources. Okay, what is EBIT include? It includes the profit of enterprise before providing for interest on loan and before charging tax and provision. As you prepare P&L, you can find that EBIT. Okay, so what interest on long-term debt include? It include all the interest payment on long-term debts like debenture, long-term loan, bank loan, loan from financial institutions, public deposit and term loan. Okay, so in the normal business 6 to 7 time ratio is considered ideal. Okay, so it is very important ratio. Now we are going to discuss some questions of DK Goyal. So solvency ratio is the first question of debt equity ratio. So first of all, what is debt equity ratio? What is the formula of debt equity ratio? Is debt upon equity ratio. So first of all, you have to find where is debt. Long-term debts are given here. Long-term borrowings and provision for employees' benefit. Added, then it will be 2,60,000. Okay, and what are the shareholders fund? Share capital, preference share capital, reserves and profit and loss, that is accumulated loss here, so it will be less. So what is the total aggregate is 4,60,000. So 2,60,000 is divided by 4,60,000, that is equals to 0.57:1. So is it good position or bad position of the company? Okay, So we compare the ideal ratio is 2:1. It is less than this ratio. So less than this ratio, the ideal ratio less than this ratio is good, but it indicates the lower amount of debt. That is, it is good, we are not dependent upon the debt, the outsider source of fund. So it is good if this ratio will be lower. Okay. Now next question is, from the following ascertain the debt equity ratio. Okay, so it is quite easy. Just you have to find out long term debts. So long term debts are 10% debenture, long term loans, long term provisions. All these are the long term debts. Okay, and after that shareholder funds, so share capital. Okay, share capital is included, capital reserves are included, general reserves are included, and P&L balance is included. Okay, now dividing by this, you can find out the debt equity ratio, that is 0.85:1. It is also a good ratio because it is below the ideal ratio, and the below one is good because we are less dependent upon debt. Now, the balance sheet of X Limited following of information 31st March, and you have to calculate, what you have to calculate, the ratio indicating long term and short term financial position. So you have to calculate debt equity ratio. First of all, you calculate debt equity ratio, and short term financial position is indicated by current ratios. So both ratios are calculated in this question. Now the 29th question is also based on debt equity ratio. So first of all, you have to calculate long term debts. So long term debts are given, long term borrowing and long term provisions. Okay, and after that you have to calculate shareholders fund. So here shareholder fund is not given, so you have to calculate first of all you have to calculate total assets, and after that you can less the liabilities, that is long term liabilities and current liabilities, and you can easily find that shareholders fund. Okay, tangible asset plus intangible assets, non-current assets, working capital current asset minus current liabilities. It is calculated here in a very significant way. You can easily use this solution. Okay. Now 37th question is calculate total asset to debt ratio. So total asset to debt ratio is total asset upon debt. So where is total asset? You have to find, here is no total asset is given. So you first of all include capital employed. So how you calculate capital employed? 60 lakh, share capital and reserves are included here. Okay, and long term debts are also included. And after that, you don't know about the long term debts because you have to find here the debt. So capital employed 60 lakh, shareholders fund is 20 lakh, 16 lakh is reserves and surpluses, and long term debts are treated as a X, that is variable. So what will be your long term debts are calculated here. Quite easy question, 24 lakh here, and after that total asset will be calculated. Shareholders fund plus long term debts plus current liability. Okay, and other liabilities are added, total asset, because total asset is equal to total liability. It is quite easy question, and now after that you can easily divide them, right? So this is very easy question, you can easily solve this. And here is question number 38. You can easily use this question. You can pause here and solve this question. Here is the solution. I zoom here. You can pause here and compare your answer from this solution, right? Because it is not that visible, now it is visible. So by pausing video here and solving the question, here I end my video, and in next video we discuss some more ratios which are based on basically P&L account. Okay, thank you, and I hope you all are solving questions, and please solve questions in your notebook so that you can easily prepare your notebook, your assignment book, because it is the basic base for marking in your board examination, in your practical examination. Okay, thank you.